14th. We are midway through the month, first month of the second quarter, and the volatility continues to rage in this market. We're back up to $108 a barrel, or just below, or somewhere around that. A little bit off this morning after a very serious rise yesterday. This market continues to be caught in a very ping pong situation. Matt Stanley, let's kick off this morning and of the sort of kaleidoscope of options to point towards. Let's start with something very simple and old-fashioned, like U.S. oil inventories, which came in yesterday at a whopping plus 9 million barrels when forecasted to be, I think, 400,000 build. We got 9 million. Does this tell us anything? What does it tell you?
No, morning, Sean. Yeah, it's nice. Look, it's nice to talk about the old things that we used to talk about in the market, crude oil. What's happening with inventories in the US. Yeah, look, it was a gargantuan build, 9 million barrels. Usually, this time of the year, we'd see maintenance seasons. So you would expect seasonally to see some builds on crude, but look, the market reacted in a bullish way. It went bid as soon as the information came out, and that was mainly down to the fact that there were draws on product inventory. So it was a fairly balanced week in terms of stats. It depends. I mean, your halftime talk this week, he made a very good point. Refining margins are doing so well globally that people are not going into turnaround season. They're going to continue to pump and refine as much as they can, take advantage of these excellent margins. It's $40 a barrel for the US 321 crack. This time last year, it was about 15. So you can't blame them at all for keeping that going. We're coming into driving season. So the old seasonal cues are there. And they're looking at ever more bullish. Bullish is probably the wrong term in a market like this, but it's onward and upward.
Let's welcome James McCallum, Executive Chairman of Exergy, Professor of Energy at Strathclyde University. James, I suppose, again, so many things one could touch on with you. Where we'll start with this sort of caught between the rock and the hard place of this market, bouncing between 100 and 110. It seems supply disruption concerns out of Russia versus demand destruction concerns and the growing threat of recession and China looking like it's having a sticky wicket. Which of those two narratives are you more focused on and more believing in?
Good morning, Sean. That's a really interesting opener there. I think, picking up on the point which Matt makes, which is one of the things for us all to sort of stay focused in on is where we believe the actual normal oil price actually would be if we didn't have these major disruptions. Is it 70? Is it 80? Where would that natural balance be? Now, you talk about OPEC. OPEC is maintaining this position that major demand destruction is going to occur, as we go through the year, and so they're not bringing to the markets additional levels of production, or at least not yet. Now, they're also quoting inflationary pressures, which, yes, I mean, we are seeing, and certainly in Europe, and the UK, we are seeing major inflationary rises there. But what is interesting is that top of the list on any news broadcast is that is being caused by increased transportation costs through increases in prices of diesel, et cetera, et cetera. So these things are self-fulfilling. I am fascinated at the moment to try and imagine, Sean, what the conversation around OPEC Plus actually is. You've got Russia saying they'll supply oil to friendly nations at virtually any price that they're prepared to take it. You've got the emerging economies like India saying, look, we're not going to be driven by, if you like, the Western agenda as to whether or not we should be buying oil from Russia at $70 a barrel or $80 a barrel. We have an economy to shore up here, and we're going to do it in exactly the same way as they reacted when the West told them not to import coal after COP26. So we've got massive dynamics going on. And I think for me, I'm sure we can come back to this, but the really interesting story in the Press Digest today was this position that CNOOC are taking, which was they're putting their assets in the United States, Europe, and Canada up for sale because they think there is a real risk of secondary sanctions kicking in because of their continued relationship alongside Russia, which of course OPEC has. So we've got this really interesting dynamic of China, OPEC, Russia versus the West sort of saying, nope, we need to pull back from Russian energy supply and find an alternative to it. And I'm sure we'll touch on that later, but I've probably said enough just now to set that up.
Let's go to our third guest this morning, Gilmyra Razayeva, founder and managing director at Eurasia Analytics. But Gilmyra, in her previous role for 10 years, was a senior advisor at the Azerbaijan Center for Strategic Studies, a think tank in support of the president of the Republic of Azerbaijan, and has a particular expertise on energy security around the Black Sea and Caspian. And it's that where I want to start with you, Gilmyra, this morning, to talk, just to get a sense of your view about, we talk about the risk to Russian crude oil making its way to the international markets, which it doesn't as of yet seem to be that disrupted. I'd like your views on the potential disruption of that, but also the wider disruption from Central Asian states, potentially Azerbaijan, Kazakhstan, and so on. Your thoughts as to the dynamics of the Black Sea and the disruption of Russian and Central Asian oil.
Good morning, Sean. Well, there is no disruption from the in supplies from Central Asia countries and specifically from Azerbaijan. Oil exports is, continuing, ongoing as it has been all this time. So you know that Azerbaijan started exporting oil since 2006 to the world market, and there hardly has been any disruption since then. So it's quite a reliable gas exporter to world energy markets. But with Central Asian exports, I think there could be some disruptions because mainly Kazakhstani oil has been exported via Russia, a lion's share of Kazakhstani oil. Has been exported via the Russian ports such as Novorossiysk, Ust-Luga, and other ports. So, and at the moment, Kazakhstan is in discussion with Azerbaijan to start transporting its oil via Azerbaijan, via the already existing Baku-Tbilisi Ceyhan gas oil pipeline. So I think Azerbaijan is becoming kind of a very important transit country for those Central Asian countries, those transporting their crude, and not only crude but also oil products to the world oil markets, via Georgia and Turkey. But apart from that, I think at the moment it's also very important to mention some gas exports from Central Asian countries, especially Azerbaijan, because now this European Union's Energy Commissioner keep consulting with Azerbaijani decision makers, president keep visiting Azerbaijan, and some presidents of the European countries are visiting Azerbaijan, asking more gas to be provided to Southeast European countries. Azerbaijan is already exporting gas to Italy, Greece, and Bulgaria, but the volumes are around, in total, 10 BCM, which the European countries would want to increase in order to get themselves wean from Russian gas supplies off. But I think So there is, I mean, there is a wrong perception in what is related to the gas reserves of Azerbaijan. Well, Azerbaijan has an enormous gas reserves, but at the moment, the country doesn't have extra volumes of gas to export to those countries, to Europe. And what Azerbaijan wants from the European Union is some, security of demand, because the country's position is that we can't act, or we can't go and invest multi-billion dollars investment in upstream projects just because of the current crisis.
Yeah,
So
you need some sense of certainty for outlook. Let's just come back to that. I just want Matt to go to you a little bit on this story. We've talked about it in the past. It now seems to be transpiring where the big oil trading firms are now following the oil majors and starting to declare a withdrawal from Russia, engaging with Russian products. Your thoughts about the announcement of Vitol this week by the end of the year and seriously reduced in the second quarter?
Yeah, I think that's an excellent point after what Gilmyra was raising about what he started off the chat this morning talking about this ping pong the market is in. We touched to a low of 97.50 on Monday. We're $10 higher than that only 4 days later. There hasn't been any new headlines specifically. The problem the market has got, and I mentioned this in my commentary on Tuesday, is that the market structure came off dramatically last week in terms of the backwardation, mainly due to the fact about the strategic reserve releases. That took pressure off them front month, and it was trading, say, $2 backward at one stage, and it went down to 15 cents. You don't need to be a rocket scientist to work out that was a good buy. And now we're trading at 70 cents in the front structure. The problem is, why did that front structure come off? Like I said, the releases are going to happen. And the likes of Vitol and Trafigura and Shell, Gunvor, Mercuria, yes, they're not going to buy Russian oil, but they still are right now. They're committed to terms in Q2. So actually, the pinch of Russian supply and really what happens, we won't see until July, right? You've got to bear in mind that there's an 8-week lead time for Chinese teapots to come in and buy their crudes. So from July, from Q3, I think the market will really start pricing in, because we will see tangible losses from Russia. And look, people argue with me. Of course they do. I'm quite an arguable kind of guy. But what happens is the difference between where demand destruction is, which to be honest, I think that the story from China this week was somewhat negligible. I know that they're coming off, but it's in no way is demand coming off as much as supply is and will. And I think that Pierre Andorand, I really agree with him, but on Tuesday, he was right. And he said the market isn't even looking yet at the effects that Russian oil supply is going to have on the market. I think $150 oil is certainly possible in the summer. And I think that really we're not going to start seeing the data coming out on how Russian oil supply is lost and cannot be replaced until the summer. That's why I think that it goes bid sometime in June, something like that.
James, the other sort of parallel narrative in where this market is going, what might break it out of this current ping pong, is the direction of the tightening cycle on Fed rates and central bank pricing, which the reporting seems to be that it's going to be accelerated, particularly on the Fed. Instead of 25 basis point leaps, we're going to 50 basis point leaps. And yet the counterintuitive reaction from the equity markets to go higher each time. There does seem to be a conflict here from the point of view of the perspective of the Fed guidance versus where the equity markets look to go. Your thoughts on that sort of conflict, and how will that end? Not pretty, I think.
No, I think that's right. And the equity markets respond to when they feel that they're on firm ground and some degree of certainty. Interestingly, if you take a look at that little equation of 25 basis points or 50 basis points, there's a long-standing sort of rule in the financial markets that sort of like says, if you take the price of oil for every $10 above what you think the normal price of oil is, and generally the price of where if you like the normal oil price would be is that price which supports developing economies. So one could say India, for instance. We hear week in, week out that India thinks that price is around $75 a barrel. Well, interestingly, if you jump up to say 110, 120, in $10 increments, that will tell you that we're going to move from 25 basis points to 50 basis points in terms of interest rates. That supports that long-standing financial equation. Now, obviously, it's anecdotal, Sean, but it's another supporting mechanism. For me, I want to just pick back up on the point which actually Matt makes, which is the markets have not yet figured in what the real Russian position is, because nobody knows what the real Russian position is right now. And equally, on the other side of the equation, what is the demand in the world for hydrocarbons? Is it 100 million barrels of oil a day? Is it 90? Is it 95? And those two things will work themselves against each other as we come through the year. At the moment, what we are seeing is that the pieces on the table of the jigsaw puzzle are just being moved around. Russia is finding alternative markets to supply its oil. So the supply side of it is not coming down. It's just moving around as different people seek to buy from a different source. Now that's creating its own challenges going forward. And that is another level of disruption that we will see coming through the rest of the year.
Well, I think also on that point, which is yet to play out, and that's going to be the competition around between Asia and Europe, perhaps for gas in particular. Right. But Gilmyra, I wanted to get your views on what looks like the next stage of this war in Ukraine, that Russia seems to be positioning itself to take over all of Ukraine's Black Sea coastline. And consolidate its position on the east and south of Ukraine. How does that impact the geopolitics of the Black Sea, Turkey, Russia, if indeed Russia succeeds in what appears to be its goal of securing the Black Sea coast of Ukraine?
Well, that certainly would involve, I think, Turkey, because Turkey is a neighbor of both Black Sea coast countries, Ukraine and Russia, and actually Turkey plays an important role in that Black Sea region. So I think that's why that's one of the reasons why Turkey, probably implicitly, is also involved in the war by helping Ukraine militarily with some military technologies, because it's definitely not within Turkey's interest for Russia to win and take control over the Ukrainian major ports, especially Odessa, from where major which is quite an important port for oil and oil products trading. Well, Azerbaijan as well, Azerbaijani state oil company SOCAR is trading its oil and oil products via Odessa port as well. So Azerbaijan has its great energy interest in Ukraine. We have around more than 100 petrol stations there and some major energy assets in Ukraine. But I think it seems that the conflict will be protracted, and I don't think that this is going to happen anytime soon, that Russia will take control over the south of Ukraine. And there are many major countries like players in the region that are not interested in this development, and I think this is something that we won't see anytime soon.
Well, what would you expect when you say others are not interested? I mean, clearly that's the case, but the question is ultimately, what can anybody do about it? What is anybody willing to do about it? We've just seen Mariupol being blasted into the 18th century. Nobody's doing anything to stop this war machine. Yes, there was a repulsion from Kiev, but ultimately Russia didn't unleash its cannons and its missiles on Kiev. There does seem to be a determined intention. What do you think would stop Russia from achieving what appears to be a progressive determination in the south of Ukraine?
Well, the determination of the Ukrainians and their fight against the Russians. If Russia could take, Mariupol or the south part of Ukraine, it would do by now. So I think it turned out that it's 50 days of the war, and this still hasn't happened. So I think it turned out that it's not that easy to take control over those major cities in Ukraine, and there are some countries helping Ukraine, although not that openly. As I said, I mentioned Turkey is quite active in that, because it's not in Turkey's interest to see Russia controlling those major parts of Black Sea on the north part of it. So again, I'm confident that it won't be that easy for Russia to take over those important ports.
Let's go to the survey question, which I've kind of focused in on this point of the interest rate, because I do think this is quite an important one. We saw yesterday in the UK the latest print of 30-year high inflation, and so the big question is how aggressive do you expect the central banks to go to tackle this level of inflation? Will they indeed do so? Will they attempt to tame it, or will they back off and we all have to plan to live with 10% inflation? I think the answer to that question is really, really important. And the Fed needs to be very clear, and the central banks need to be very clear, is how aggressively they're willing to fight inflation. So my question to you this morning is, how high do you think the Fed needs to raise rates before inflation capitulates? How high do you think the Fed needs to raise rates before inflation capitulates? Some people argue the number is low because ultimately debt levels are so high that even 1% move in interest rates will knock everything back. Others articulate differently, and there is even members of the Fed now saying that we need every rate rise to be 50 basis points and so forth. So I welcome your view. How high do you think the Fed needs to raise rates before inflation capitulates? And we move into sort of wrap up thoughts. Matt, it is in our context the end of the Middle East week. Oil prices, as we say, trading back from 110. Brent doesn't seem to want to go below 100 for very long, a few minutes, doesn't seem to want to go above 110. As we move into the Middle East weekend, what will you be watching? How serious do you think the China situation is vis-a-vis demand destruction?
Yeah, I just want to stick on the theme that James and I at Gilmyra have touched on as well, about moving these pieces of the supply jigsaw around and what it means for the Middle East specifically, because it's been quite quiet about what's going on, Russia and Ukraine, taking a very cautious approach. Ultimately, the losses of Russian crude will need to be replaced. Now, Marathon Ashland, big refiner in the US Gulf Coast, bought a cargo in Murban yesterday. That's highly unusual for Middle East cruise to go into the US Gulf Coast, especially for Murban, because the pull from China is usually so high. It's a high distillate yielding crude. So when you're ramping up for the summer and you're looking at diesel and jet fuel demand specifically, I don't think international travel will happen quite as it usually does in the summer when people go to the Costas, whatever. But intra-US, certainly I see that demand picking up. So what does it mean for people like Saudi and especially ADNOC? You're already seeing, Sean, people replacing Russian crude oil with other grades. All that will do is push up premiums, and that is only going to have an effect on flat price. It will have to keep up. All these OSPs we've seen from all the Middle East producers and the core GCC, KPC, Q8, ADNOC, Aramco, the OSPs are at record highs. People need the oil. Now, the one thing that hasn't been discussed in the last couple of weeks is the Iran talks. And as I've mentioned to you, I think the last 3 times been on the webinar, is Iranian light is the replacement for Urals crude, which the refining diet in Europe strictly runs on. I think that there must be some discussions going on, because the issue that the EU have got at the moment is Hungary and Germany seem to be the people who are pushing back against banning Russian oil imports. I don't think they will have a choice, to be honest. But there must be some mitigating talks. Well, where do we get the oil from? I think Iran features heavily in those talks. Mm-hmm. So that's on the supply side. Demand side, look, I think people are going to look at Chinese economic data ever closer, because Evergrande, what's happening with Evergrande? There's another couple of property developers that have defaulted on some debt. I think that will be watched extremely closely. And obviously their zero COVID policy is relentless, and they're giving themselves a tap on the back.
I think that is a really good point around Evergrande, because ultimately, when you think about what does come out of China in the last day or two, the idea of stimulus and spending, there is no more highways to nowhere you can build. There's something like 90 million enough vacant apartment space in China to house 90 million people. There's no more apartment forests that you can build to stimulate growth. So where does stimulation come from in China?
Well, that's the point, Sean. And leading on to your survey question, which is another good one. And I usually say that they're a bit rubbish, but this one was quite good today. So it was well done. Just leading on from the inflation argument, which is going to be key, is even if China, their own economy coughs this year, inflation will still feel it because they're locked down and end user goods are stuck in China, or containers are stuck in China. That end user supply crunch is going to be there, and that's going to affect inflation massively. So the fractured state that the world is approaching China with at the moment is an odd one. We've never really experienced it. If China fails, it's bearish for overall economic sentiment. But if you can't get the goods that they're producing, it's going to add to the inflation argument. So it's a yin and yang.
Well, there's a lot there to add to the inflation, and it does seem, and coming back to the original point, James, that the equity markets just don't believe the Fed or others are going to be robust sufficiently to contain 9-10% inflation. But I'd be remiss, James, if I didn't ask you, as one of the world's leading drillers, why is there not more drilling going on in the US? And where there's some sort of concerns now that the majors have lots of money again, that they're giving it back to shareholders and not putting it in the ground. Do you expect that to change?
Yes, I do. And a very simple answer, and I've made this point before, is the lack of access to equipment to actually make that happen. And we're definitely seeing that in the shale sands. Now, you're picking up on Matt's point. There are a couple of leading indicators that support that. The last time I was on the OSX index, which is the Oilfield Services Index, was in the mid-40s. It's now at 80, which tells you that the service companies, their share prices and the drillers who are in that OSX index, their prices are jumping in anticipation of activity. Back to your long-standing point, Sean, around responsible investment capital versus irresponsible investment capital as defined coming out of COP26. If you take a look at the banks that have been lending into, amongst other things, Canadian oil sands, the major Canadian banks have loaned $9 billion into Canadian oil sands in the last year. So traditional activities are coming to the fore. BP's share price, Shell's share price, up 50% in the course of the last 4 to 5 months. Interestingly enough, Ørsted, the company that moved away entirely from hydrocarbons, share price down 25%. So the markets are taking a look at the oil and gas, traditional hydrocarbons companies coming back into favor. Now, for me, that you have to play against that. My colleague Nigel Filer posted in the chat room, McKinsey came out yesterday and said that peak oil demand will come in 2027, particularly as Europe begins to migrate towards alternatives to hydrocarbons as a part of their energy supply chain. Look, ultimately, Sean, for me, I think Matt's point around supply, there's an interesting article around the United States affording Iraq leniency against importing electricity from Iran. that for some people is seen as a gesture towards Iran as part of those nuclear talks. So there's real things happening out there to find alternatives to Russian supply if it falls away later in the year. But none of this is going to happen quickly, Sean. None of this is going to actually happen quickly.
Let's give Gilmyra the last word this morning on this idea of the structural shift and the survey results. How high do you think the Fed needs to raise rates before inflation capitulates? 5% plus getting most of the thoughts in this room. Gilmyra, I wanted to get your thoughts on the structural change, the move to energy security as an ultimate priority for Europe, and the opportunity that presents perhaps for Turkey. We saw the US Deputy Secretary of State in the Near East Med this week, basically sort of realigning the chips there a bit, bringing Turkey very much into the discussion of the pathway of Eastern Mediterranean gas into Europe. I'd like your thoughts on that, and also how quickly, how much can Europe restructure its energy security in the midterm? Sorry, you're on mute. You're on mute, Gilmyra. Yeah.
Yeah, sorry. So it's definitely won't be that fast as Europe would want to, because we are talking about around, if we're talking about gas, then it's more than 100 BCM of gas, which won't be easy to replace anytime soon. And I think we can see Europe winning itself off from Russian gas by 2030, but a lot of things needs to be done. If we look at the alternatives, well, I talked about Azerbaijan. We do have enormous potential, but we need the long-term contracts to secure, investments and production. I think this is the position of other countries as well. So speaking about Middle East, well, it's first of all Israel that can provide some gas to Europe, and it seems that LNG and the route via Turkey would be the most commercially viable one. LNG is good, but the price for LNG is increasing enormously, and it's for instance, for Europe and Turkey, depending on the price formation, it's above $1,000, which is like almost 10 times more than we saw the LNG prices in 2020. Pipeline via Turkey to Europe is another option that currently Turkey, Israel, and Europe are considering. At the moment, it seems commercially viable given very high gas prices in European major hubs. But what's going to be with the prices in next few years? So that's a good question,
Well, there becomes the issue, doesn't it? Energy security versus energy economics. I wanted just to get your final point, Gilmyra, on how big a role can the United States play in compelling these new flows of energy, like we saw the Undersecretary of State in Cyprus, in Turkey this week, sort of imposing, or at least putting forward robustly, the US position? Do you think they have the diplomatic muscle in that region to compel new flow direction?
Well, I think we need the diplomatic muscles. The US once showed these muscles in my region, in Azerbaijan, and we managed to put in place multi-billion two projects, oil and gas projects, the Southern Gas Corridor and Baku-Tbilisi-Ceyhan oil pipeline. So that was thanks to the US enormous political backup and support, and backup, from Russia, because obviously Russia was opposing those projects, and we managed to realize those politically complicated projects, commercially very expensive projects, and we need the same, muscles and same political backup now with those new projects as well. Another problem, I think, this is a major obstacle, is given this energy transitions. It's a kind of a hysteria, I would call. The EU's position is that I want more gas coming from alternative sources, but I don't want to finance, fossil fuels fuel projects. I want gas, coming as soon as possible, but I want clean gas. I want, as clean as possible. So a lot of conditions, a lot of terms, and I don't think that this is gonna help with diversification of supply sources.
Well, I want to unfortunately have to bring this session to a close because we've well over our half an hour together. Gilmyra, really appreciate your insights today. Great to have you, and hopefully you'll be back more often. Matt, as always, you look great as the new Carol. And James, although I like your Irish backdrop, I think there's nicer ones in the West, but nonetheless, it looks quite similar. That backdrop. Thank you, everybody. Have a great weekend. We'll be back on Sunday to see where
Happy
all
Easter.
this goes. It's Easter. Is it
Yep,
Easter this
happy,
weekend? Oh,
it is. Happy Easter.
Mackers,
Happy
Easter.
Easter.
What does Easter mean anymore? But I remember when I was a kid, I used to go on the Easter in Jerusalem because we lived in Jerusalem, and that made it a little bit more tangible than Easter eggs at Spinneys. But that's the way it is. All the best, everybody.
Cheers.